With President Trump, a past performance is certainly no guarantee maybe of future results. Our very own markets editor, Jared Blikre, taking a look at equities performance before and after Trump's inauguration, sharing his findings with us now. Jared.
Thank you, Shauna. We've only had 6 full trading days since President Trump's inauguration, but markets are already showing a different color under the new president than the 73 days between the election and last week's inauguration. The blistering rally in crypto and NASDAQ stocks, which were up over 6%, as we can see here, is morphing into a more cyclical-driven rally that's favoring the Dow, which was up 3% after the election, and then another 3% since last Monday. Meanwhile, the NASDAQ is down about 1.5%. And before we get into the sector winners and losers, which are pretty surprising, we should take a look at what happened under Trump 1.0 in 2016 and 2017. Much like the current backdrop, under Trump 1, the dollar and treasury yields soared in anticipation of the Trump trade. But unlike the current setup, Bitcoin and gold didn't fare so well into the inauguration in 2017. However, afterwards they soared as the dollar and rates reversed to the downside. Fast forward to today, and as Trump spoke last Monday, U.S. rates and the dollar, they tanked, and the dollar actually had its biggest drop in over a year. In a matter of hours, one of the biggest investor concerns and risks, that strong dollar wrecking ball, it seemed to fade in investors' minds. And this set the stage for a massive reversal in large cap tech, which we can see here among the S&P 500 sectors, where we're showing gains and losses in market capitalization. So tech stocks, they gained over $500 billion in value from election to inauguration, but have given back more than that, $600 billion. And in terms of winners and losers, we have several sectors which have posted impressive gains both before and after the inauguration. Consumer discretionary, that's home to Amazon and Tesla, they tacked on $850 billion, then another $60 billion in the 2 periods. It's impressive, as Tesla has actually been a huge drag since the inauguration, and we're going to get to that in a minute. Meanwhile, financials and communication services, home to Meta and Alphabet, they've also performed well in both periods. But we do have some reversals. In addition to tech, energy was up 3% prior to the inauguration and is now down over 3%. Utilities, which are now an AI infrastructure trade, in some cases, they were up slightly and are now trading down. Then we have consumer staples, materials, and real estate. They were all down, but are now trading to the upside. The biggest surprise, though, it might be healthcare, which shed over $300 billion in value after the election, and since inauguration, it's up over $250 billion. So if there's any theme here, the AI trade is giving way to a mix of cyclical and defensive names. And we see these dynamics playing out in America's biggest stocks, starting with Tesla. After the election, Elon Musk's flagship company tacked on an impressive $560 billion. Since inauguration, it's shed about $100 billion of that. And we've seen a similar pattern of big gains followed by a give back in other mega caps like Alphabet, Broadcom, and Apple to a smaller degree. And we have to talk NVIDIA, the giant outlier here, which shed nearly $600 billion in one day after the inauguration. It's clawed back some of that, but it's the only mega cap that was down both before and after the inauguration. I think the broad takeaway is that the so-called Trump trade, it's a moving target. And the dynamics that we saw after the election have faded somewhat, very similar to what we saw under Trump 1. And for that matter, it's something we've seen with many pivotal elections. If history is any guide, then tech will find its footing again, so will Tesla and Bitcoin, and the Dow will not lead forever. It's an unavoidable fact that the emerging trends that we're seeing right now will eventually reverse as well. But right now, we have the beginning of a roadmap for the first 100 days where the strong dollar might not quite be the immediate risk that investors had feared.